Welcome to the Deep Dive. This is your go-to place for really understanding the forces shaping your financial journey, especially here in India. We try to cut through all the noise,
Exactly. No wading through dense reports. We're here to distill it down.
Today we're laser-focused really, on the Reserve Bank of India's latest monetary policy announcement. And crucially, what it means for you, your investments, your savings.
That's right. We've looked closely at the minutes from the RBI's Monetary Policy Committee meeting. That was April 9th, 2025, and also scanned through quite a bit of expert analysis.
Okay, so our mission today is pretty straightforward. Break down what the RBI decided, explain, how this is supposed to help the Indian economy.
Pinpoint what's in it for you, the retail investor.
Yeah, and maybe suggest some smart things you could think about doing. So let's just dive right in. What's the headline? What's the big news from the RBI?
Well, the main story, I think, is a pretty clear shift. The RBI seems to be putting more weight now on supporting economic growth.
Okay. How are they doing that?
The key decision was that the Monetary Policy Committee, the MPC, they voted unanimously, actually, to lower the policy repo rate.
The repo rate.
Yes, by 25 basis points. So that brings it down to 6%.
6%. Okay, a rate cut is always noticeable.
Yeah.
But I think I read their overall stance changed too.
You did, and that's, arguably even more significant than the rate cut itself. The RBI has officially changed its monetary policy stance. It's gone from neutral to accommodative.
Accommodative,
Oh,
right.
okay.
That sounds like it means something specific here. Can you break that down for us?
Sure. Think of accommodative as a signal. The central bank is basically saying, look, we're leaning towards cutting rates further, or at least keeping them where they are, to help the economy.
So a rate hike is off the table for now.
That's the implication, yes. It suggests they want to stimulate things through, softer interest rates, especially with all the uncertainty floating around globally.
Okay, so barring any major surprises, we should probably expect rates to stay put or maybe even dip lower going forward.
That's the signal they're sending, absolutely. The minutes were quite clear. Unless there's a big shock, the MPC is only really thinking about either holding steady or cutting more.
Right. So what pushed them to do this now? What were the main reasons behind this decision?
Well, there are two primary things, really. First off, inflation. It's actually been behaving itself, relatively speaking.
Okay.
It's hovering near the RBI's medium-term target, which is 4%. Back in February 2025, CPI inflation was, I think, 3.6%.
So under control.
Pretty much. And the RBI's projection for the next financial year, FY26, is also around that 4% mark. They seem fairly confident, citing, expected good harvests for wheat and pulses and generally benign food prices.
That makes sense. If inflation isn't a major worry right now, they have more flexibility, I guess, more room to focus on growth.
Exactly. Which brings us to the second factor, economic growth itself.
How's that looking?
Well, domestic demand has been okay, sort of holding up, helped by rural areas and government spending. But the RBI seems to see the overall growth as just moderate.
Moderate, okay.
Yeah, and they've actually nudged down their GDP growth forecast for FY26. It's now 6.5%. They mentioned global trade disruptions as a key reason.
The global picture.
Right. So the thinking now is really about strengthening demand here at home to keep the momentum going or even accelerate it.
Okay, so lower rates are meant to encourage businesses to invest, people like you and me, to spend a bit more.
That's the core idea. And importantly, the RBI isn't just cutting the rate and, crossing its fingers.
Right.
They're also taking active steps to make sure there's enough money flowing through the system. Liquidity measures, they call them.
Liquidity measures. Yes, we hear that term a lot. What are they actually doing on that front?
They've been quite active. For instance, buying up government bonds, about 40,000 crore worth.
Okay.
And they've also conducted these things called long-term variable rate repo operations. Quite a mouthful, but basically injecting funds. That's totaled about 1.5 lakh crore since that April meeting.
Yeah. Wow, those are pretty big numbers. And wasn't there something else? A change plan for next year?
Yes, exactly. Amendments to the liquidity coverage ratio framework, the LCR. That kicks in from April 2026.
LCR. That's about how much cash banks need to keep handy, right?
Essentially, yes. It's a rule about banks holding easily sellable assets. They're planning to tweak this rule, effectively loosening it a bit.
Which means?
It should free up more funds that banks can then lend out. The estimate is it could release an extra 1 lakh crore of loanable funds into the system.
Okay, so we've got lower interest rates, potentially more money available for banks to lend. How is all this supposed to help the wider Indian economy? What's the grand plan?
Well, the most direct aim of cutting the repo rate is just making borrowing cheaper for businesses, for individuals.
Right.
And that can have knock-on effects. For companies, cheaper loans might make them think, okay, maybe now is the time to invest in that new factory or upgrade equipment.
Which you hope leads to more jobs, more economic activity overall, and for individuals.
Same logic, really. If loans for things like buying a home or a car become more affordable, people might be more willing to make those big purchases. That boosts consumer spending, particularly in those important sectors.
So it's really about trying to stimulate things from both ends, business investment and consumer spending,
Yeah.
especially, as you said, with the global economy looking a bit shaky.
Precisely. The RBI governor was quite explicit about needing to strengthen domestic demand to sort of cushion India against potential global headwinds.
Like those trade disruptions you mentioned, tariffs and things.
Yeah, exactly. Stuff like tariff waves could hit exports, hit investment. So this accommodative policy is partly designed as a buffer against those kinds of global risks.
Okay. The big picture strategy is becoming clear. Now let's really zero in on what this means for us, the retail investors listening in India. How does this actually touch our finances?
Well, for starters, if you have loans, especially floating rate ones, think home loans, maybe car loans, you might start to see slightly lower interest payments down the track. That depends, of course, on banks actually passing the rate cuts on to customers.
Which isn't always immediate, is it?
No, not always, but the direction is favorable for borrowers. It's definitely something to keep an eye on in your loan statements.
Okay, good news potentially for borrowers. What about the other side of the coin? For savers?
Yeah, that's the flip side. If you're relying on interest from, say, your savings account or fixed deposits, FDs,
Which many people are.
you'll likely find those rates staying low or maybe even nudging down a tiny bit more. That's just typical when overall interest rates fall.
Right. So borrowing gets potentially cheaper, saving gets potentially less rewarding in terms of interest. How does it play out in the stock market, our equity investments?
That's always the million rupee question, isn't it? The reaction so far seems to be one of, I'd say, cautious optimism.
Meaning,
Meaning we didn't see the markets shoot up dramatically right after the announcement. Investors are clearly still watching that global situation, the trade stuff. But the underlying logic is that if companies can borrow more cheaply, that could eventually lead to better profits for them. And better profits should, over the medium to long term, be positive for their stock prices.
so potential upside, but maybe not immediate. And definitely with caveats about global risks.
I think that's a fair summary. It's not a guaranteed bull run trigger, but it's certainly a supportive factor. One thing to consider, though, is that historically in India, rate cuts haven't always directly meant people rush out and spend more. Sometimes, if sentiment is cautious, people save the extra bit instead.
Interesting point. Are there any specific areas or sectors that might be more impacted that maybe we should pay attention to as retail investors?
Well, given the RBI's explicit focus on boosting domestic demand,
Right.
it stands to reason that sectors catering mainly to the Indian consumer could benefit. Think consumer goods, retail, perhaps some services tied to domestic activity.
So companies less reliant on exports, more focused inward.
Potentially, yes. Companies with strong brands or pricing power within India might be better positioned. It's definitely worth thinking about how this domestic focus aligns with the sectors you're invested in or considering.
Okay, that makes sense. So we understand the potential impacts now. What about actions? What are some concrete steps a retail investor in India could or maybe should take right now?
First, if you have existing loans, especially variable rate ones, now's a really good time to just review them.
Check the details.
Yeah. Keep an eye on the interest rates being charged. If market rates continue to drift down, see if there are opportunities to refinance. You might be able to lock in a lower rate or reduce your EMIs.
Always worth checking if you can save some money there. Good advice. What about on the investment side? Should we be changing our strategies?
It's definitely a moment to reevaluate. Think about how this lower interest rate environment affects different parts of your portfolio. Well, as we said, returns on traditional debt instruments like FDs or maybe some debt mutual funds might be lower. So ask yourself, does your current allocation between debt and equity still make sense for your goals and your risk appetite?
So maybe consider if a slight shift is needed.
Potentially. The emphasis on domestic growth might make certain Indian equity sectors look a bit more attractive, perhaps, relative to pure debt investments right now. But it really depends on your individual situation. If you're heavily in short-term debt funds, for example, just be aware the returns might be modest.
Okay, so review loans, reevaluate the investment mix. What else?
The big one, always, is stay informed. It sounds basic, but it's crucial.
What should we be tracking?
Keep watching those inflation numbers. Are they staying under control? Look at the GDP growth figures as they come out. And definitely keep tabs on global economic news, particularly anything related to trade.
Because all that feeds back into what the RBI might do next.
Exactly, and what the markets might do. These things will shake future policy and investor sentiment.
Right. And it's also important not to get lost just in the latest RBI announcement, isn't it? To remember the bigger picture.
Absolutely vital. Monetary policy is, just one factor influencing your investments. Don't lose sight of your long-term financial goals.
Stick to the plan.
Pretty much. Stick to your plan, make sure your portfolio is diversified across different types of assets to manage risk, avoid knee-jerk reactions based on one policy change or a few days of market movement. For many people, that home loan EMI is a huge chunk of the monthly budget, so even a small rate reduction feels significant. But investment strategy needs that longer view.
Excellent points. Okay, let's try and wrap this up. Can we summarize the key takeaways from this deep dive for the retail investor in India?
Sure, I think the main message from the RBI is a clear signal. They're leaning towards supporting growth right now. They're doing that by cutting the repo rate, adopting this accommodative stance, and making sure there's enough liquidity. That's possible because inflation seems contained for the moment.
Okay, RBI focus is on growth. And for us, the retail investors, what does that mean practically?
For you, it could mean potentially lower costs if you're borrowing money, good news for loans. On the flip side, returns on some savings instruments like FDs might stay low or even dip a bit.
And investment opportunities.
The focus on boosting domestic demand could create opportunities in specific sectors catering to the Indian market. But that comes with a but.
Which is?
It's really crucial to remember the global backdrop is still uncertain. Trade tensions, other global factors, they haven't gone away.
So the RBI will be watching closely.
Very closely. They'll monitor inflation, growth, the global scene, and their policy could definitely evolve if things change. This accommodative stance isn't set in stone forever.
Right. So what's the final thought we want to leave our listener with today? The main takeaway, action, or perspective?
I'd say stay informed, definitely. But more actively, use this moment to review your own financial situation. Look at your loans, look at your investments. How does this RBI stance, this focus on domestic growth, fit with your personal financial goals, your timeline, your comfort level with risk?
It's about applying the information personally.
Exactly. This deep dive gives you the background, the foundation. But ongoing learning and really thinking about your own specific circumstances, that's what's key to navigating the market successfully over the long run.